Hello and welcome to Fund to Money. Here we will be discussing an important topic which is basically ULIP costs, the costs that are involved in a unit linked insurance plan, ULIP, which is offered by life insurance company. As we know, it's a combination of life insurance, it provides life insurance and also investments in market linked, it's a market linked investment where you buy units of a fund, and the mix of investments of that fund totally depends on you. You can choose a fund depending on your risk. So we won't be talking about ULIPs, but we will be talking about the costs that are there in ULIPs. We'll be talking about the major ones, which are you typically incur them, and we'll be talking about them. And why is that important? Because like in any investment product, after you've taken into account the cost, the net amount is the amount of your contribution or your investment that is getting deployed. That is the amount that is being deployed. That's the amount that will grow. So you need to know what is the amount that is going to be deployed from the amount that you're giving. So if you're investing say 10,000 rupees, that's not what's getting invested. The cost take care of, there's a deduction of cost and the net amount gets invested. Now when ULIPs got started in the 2000s, that's almost over 2 decades back, the costs were high and there was a lot of outcry. Over a period of time, those costs have been brought down, but still you need to know about these costs like in any other investment product, because then you would know whether you're prepared to incur these costs, and why are you combining investment with life insurance, because that combination is happening here. You can do it separately also, so you must have a very good reason for doing that. So it's very important for you to know about these costs. These costs are also important because a lot of times people don't give enough consideration before they buy life insurance investment products, especially ULIPs, and they get to know about these costs when they get to know that they made a mistake and they want to exit. That's when you get to know about it. So when you because these are long-term investment or long-term financial products, there is a certain amount of impact that you face if you want to make a premature exit. So instead of you getting to know about these costs later after you bought them, it's important that you know about them, so you know that there is a substantial impact that you will have if you make a premature exit. That's true with a lot of these long-term investment products. Either you cannot come out, or if you come out, you'll come out bruised. So these are long-term investments, so you need to know about them. So we'll be talking about first what are the major ULIP costs. There are 5 of them that we're going to be discussing. We're not going to be discussing some of the other optional sort of costs or charges. So the charges that we'll be discussing are the premium allocation charge, policy administration charge, fund management charge, mortality charge, and then we're going to be talking about the discontinuance charge or the surrender charge. So these are the 5 charges we're going to be talking about. We're not going to be talking about some of the optional sort of charges, like you can make a switch from one fund to the other. So till a certain number of switches, things are free in most life insurance companies. After that, you have to pay a charge. Top up, you can increase the amount over and above your premium. So we are not going to be talking about, and after a certain number of transactions, etc., you have to pay. You might have to pay a charge. Premature or shall we say partial withdrawal, we might have to pay a charge if that is allowed. So we're not going to be talking about them. We're going to be talking about these 5. The reason why this becomes important is that if you know these charges before you're buying a ULIP, then you can align everything. You will be able to align what is the amount of money that is going to get invested. You have get a broad idea to where what is the kind of sum money that you can take a look, probably expect this. So you can keep that in mind, and apart from that, you can align it with a goal that you have. So you plan it well, right? So in the first section, which is the next section, we'll be talking about four of these charges, which is the premium allocation charge, the policy administration charge, and then fund management charge and the mortality charge, right? And in the subsequent sort of section, we're going to be talking about the discontinuance charge or the surrender charge. So we'll be coming back shortly with the next section. Don't go away. Welcome back. Welcome to Fund to Money. We are discussing ULIP charges or ULIP costs, and as you mentioned, we will be discussing five major costs or major heads of costs as far as ULIPs are concerned, unit linked insurance plans. And so in this section we'll be discussing four of them, and we'll be giving in the final section a much better idea of the fifth cost, which is the discontinuance charge or the surrender charge, and we'll be discussing how you can actually get the whole fix of all these charges and take a good informed decision. So that's what we're going to be doing. So let's jump into it. Let's get started with the first charge. First charge is premium allocation charge. When you're about to when you start off with a policy, this is what gets levied on the premium. It gets deducted on the premium. It's a percentage of your annual premium, and basically it's for underwriting charges, medical expenses, but an important component is the commissions, right? So commissions to whoever is selling you, whether it's a financial advisor, it could be a bank. So it gets deducted from your premium, and then of course other charges are also there. And now one of the things that you need to look for when you're buying the product is how big is this charge. So over a period of time, as we have mentioned, that IRDA, which is a regulator, they have brought down this charge significantly. Now, is this significant? You need to know what is actually the impact. So we'll tell you a little bit more about it. But the question is, it should not be too big, too much, because if in the these charges are typically levied in the initial years of the ULIP term, right? So the first year it will be quite a bit, maybe it will typically taper off in the second, third year, and then it will not be there. So that's how it's going to be. Is it large, the charge, and how long is it lasting? So when you're comparing ULIPs, this is a very important thing to keep in mind. Now suppose this premium allocation charge is 20% of your annual premium, so annual premium is 20,000. That means your only 16,000 is getting left for you for it to be to be deployed. Of course, there are other charges which we'll discuss that will come in. So for online ULIPs, the commission bit is not going to be there because you're buying it directly, right? So there you save that, and as a result, more amount of money in the initial period is going to get invested. Now, what is the implication of this? So we keep getting queries, and people keep writing to us that they have paid one premium or two premiums, and they want to surrender. Now remember, this premium allocation charge is taking a big bite out of your premium in the first couple of years. So unit linked insurance plan, because you're investing it in the markets, you basically, what you need to do is make sure, you need to be very sure that you want to do this. First, combine insurance with life insurance with investment. You need to have a very good reason for doing that, because you're paying all these charges we will be discussing. And second, you have to be sure that this is for something which is a long-term thing. If you need your money in 5 years, this is not, ULIPs is not a product to be looked at. For that matter, any life insurance cum investment plan, regardless of what it is, because they typically, you have to wait out the term, okay? And if you're investing in equities through ULIPs, then you need to give your money that kind of time to grow. So that is number one. If you actually are going to be surrendering it or getting out of it in the initial sort of years, remember these huge bites are getting taken off. So you will be left with much less than what you think, right? So that's number one. And this is something that you need to keep in mind. Then the next charge is the policy administration charge. It's again a percentage of your annual premium. It is deducted every month, right? So this is basically to keep your policy going and moving, keeping you informed, etc., etc. All this is for the running active, to keep the policy active. This is going on. So this is getting deducted. It's more in the initial years. It's their deduction is happening in the initial years, and then typically in the first 5 years, and then it goes away. Now it can be at a high rate, tapering down. It can be at the same rate. It can be, so you really need to see how the product is structured. Again, if it's a high charge or it is remaining for a longer period, then this is something that you need to keep in mind, that do you want to do this. Second is, it is done through redemption of units. So you already, when you're buying, your premium has bought certain units, so they are getting cancelled. Those units are getting cancelled. That's how it's happening. So that's number two. So we have already talked about two charges, and they're right there making their impact in the initial years, right? Okay, and then of the ULIP term. Then you have the fund management charge, which is basically fund managers are managing your fund, they're investing it, you're paying for the expertise. Now the IRDA has made the charges come down. There's an upper limit of 1.35%, which is pretty good. And for equity-oriented ULIP funds, for debt-oriented funds, it will be obviously lesser. So you need to check these things when somebody's selling a ULIP or you're buying it yourself. What are the impact of these things on what you want to do? What's your financial goal for which you're trying to do? What is the requirement you're trying to go for? Because if you're going to be staying in a financial product for this longer time, you might as well have a goal, and that's what makes sense. It could be children's higher education or retirement or what have you. So you need to keep that in mind, right? So they are typically deducted from the fund value before the NAV is calculated. Okay, net asset value of the ULIP fund in which you're invested, it gets deducted before the NAV is calculated. So this is the third charge. The fourth charge is the mortality charge, because they're providing you life insurance, unit-linked insurance plan. So that charge is getting deducted. So that charge, when you're buying it, it depends on the age at which you're buying it, your health. Does it have any risk? Are you in a risky sort of profession? Your risk is being evaluated. There are already mortality tables at that particular age. What are the chances of people dying and stuff like that? So all these things are there. So based on all that actuarial sort of data and information and knowledge, that charge is going to be levied, and they get deducted on a monthly basis. And the important bit is, in the recent years, some of these plans are they have a feature of returning the mortality charge at the end of the ULIP term. So you need to keep in mind whether that feature is there and how it's comparing on other costs. So clearly you can see from the four charges that we have talked about, or the cost that we have talked about, when you're buying a ULIP, you need to put a little bit of thought. It's not just about how long you're going to pay a premium. That's important. But these charges are actually determining the investment outcome, and whether it's going to suit suit your requirement. There would be a particular need for which you're investing. So we have not talked about four charges. In the next section, we'll be talking about discontinuance or surrender charge. That's important, and we'll be also talking about how to add up all these charges and what does the final picture, how to make the final picture out of after all these charges, and what are the other things you need to keep in mind. So we'll be back with the final section telling you about ULIP charges. Don't go away. Welcome back. Welcome to Fund to Money. We are in the final section on this discussion on ULIP charges or ULIP costs, unit linked insurance plan charges or costs. We've told you why it's important. We've already discussed the 4 charges, which is the premium allocation charge, policy administration charge. We have discussed fund management charge, and we have also discussed the mortality charge. Now here we're going to be discussing discontinuance charge or a surrender charge, and we'll try to discuss about how you can make a big picture, overall picture of the whole thing, of the charges, and what are the other things you need to keep in mind in terms of strategy. So let's get started on discontinuance charge. Now, if you want to quit a ULIP before the term gets over, you are locked in for 5 years. Before 5 years, you cannot do a thing. So we get all these queries about, oh, I paid a premium and for 1 year, 2 years. Well, you can do whatever you want. You're locked in for 5 years. So very important thing before buying a ULIP is ask yourself that do you want to get into a plan where you're locked in for 5 years. There's no point in somebody telling you and you believing that, oh, you need to just pay premium for 3 years and then it'll be all fine. Forget about it. If somebody is telling you, just go away from that person, because that person is, well, we can't use that word. Important thing is you're locked in for 5 years, whether you pay premium for 1 year or whatever. Now, when you are making a premature exit for some terrible reason you're doing it, then remember, it's apart from all the charges you've already been hit by, all these 4 charges, this is another charge that surrender charge you'll have to pay, and after that you pay the surrender charge. The money is put in a what is called as a discontinuance policy fund. It could be on any other name for all you may care, but it's in a fund that will be kept, and it will earn some basic interest, and some charges will also get deducted. You should not be thinking about a surrender when you're buying one. But if somebody is actually making that into an important point that you can pay premium for a certain amount of time and then get out of it, then obviously that person or whatever, that organization is misleading you, because you're locked in for 5 years, right? Now, the charge that's the surrender charge that you pay cannot exceed 0.5% of the fund value. And the other thing is that there are certain determined sort of numbers. So if you're paying a premium more than annual premium of more than 25,000 rupees, after first year 6,000 rupees you pay, after the second year you pay 5,000, after the third year you pay 4,000, and after the fourth year you pay 2,000, and after 5 years there is no surrender charge. So, but because you have already been paying some of these charges, like the premium allocation charge and policy administration charge, you obviously are not going to be able to recover as much of the premium that you might generally be thinking. So you're going to be disappointed if you are going to not be there in a ULIP for the long term. So it's very important for you to ensure that this is a long-term investment. You don't need the money like in 5 years or also. You need, the money is required. You need to see out the whole term. If things go south, things get difficult, even getting the money out before time is going to be a problem, unless there is a provision for premature withdrawal, and you need to check that. So it's not about how many years or how many annual premiums you're going to pay. Is if you're looking for liquidity, check whether you can is there any provision for making some premature or partial withdrawal, or there's some kind of loan you can take or something like that. So you need to check that out, right? So this is the amount that we talked about was for premiums more than 25,000, annual premiums more than 25,000. For premiums less than that, the amounts obviously will be lesser. Now, how do you make a big picture out of this, all the charges? Now remember, it's these are the rules. Okay, so when somebody is giving you the facts, you need to remember, you need to check this either if you're being sold or you're doing it yourself. So suppose you don't take account of the charges and you invest in a ULIP, so you can do it for 4% and 8%, which is a standard projection. So what amount of money you can expect out of investment, you can substitute it at 4% and 8%. So you do that, you can arrive at that figure, that will be the gross yield. Okay, so that's a term you don't have to bother about, basically without charges. Okay, and then you bring into the charges, except the mortality charge. Now that, if you call that a net yield, that's net of these charges, but you're not taking into account mortality charge, because a life insurance product will obviously be having any life insurance product will have a life insurance coverage. So the difference between the two should not, for a 10-year, up to a 10-year term ULIP, should not be more than 3%. Basically, the amount without the charge, taking into account the charge, and the amount which is where you're taking into the account the charges, right? The difference should not be more than 3%, and if it's more than 10 years, it should not be more than 2.25%. This is a super critical requirement. So anybody who is selling you a ULIP, please make sure that this is something that's happening, and verify that this is happening. You're getting it from a company, from a credible source. Okay, credible little sales, benefit illustration is being done. Some random Excel sheet printout shouldn't be coming to you. You deserve better. You're going to be paying a lot of money. So it has to come from a proper source, and you can download the product brochure. If that illustration is being done, it's better to rely on those numbers than some random numbers that are coming to you. So and remember, any projection has to be done at 4% or 8%. You'll find those asterisks and stars out there, and you can look at the bottom at the notes that are being given. It has to be at 4% or 8%. Now, so basically, what this does is it clearly brings out that you need to pay a lot of attention before you buy something like a ULIP. Any long-term insurance product or long-term investment product, you need to pay a lot of attention. You need to take a look at the charges, because remember, these charges will keep biting, and if the initial part, the bite is more, then you need to stay longer, because you have to compensate for that initial bite that you're suffering. So and so therefore it has to be always for a long-term requirement, right? So as you mentioned, for top-ups and switching and partial withdrawals, there can be other charges. We're not discussing them. There are other discussions in our channel regarding them. We hope you found this useful. If you've liked it, hit the like button, share it with others, and subscribe to our channel. Get connected with us on all leading social media networks. And till the next time, you know what I'm going to say. Take very good care of yourself, and goodbye.